Hello and welcome to NIFA's Webinar Wednesdays, a weekly virtual series specifically designed for Nebraska communities and housing partners. Today we will be discussing the topic of COVID statistics. I'm Joe Spitzen, Assistant Manager of the Regional Housing Accelerator Program at the Nebraska Investment Finance Authority. Due to the pandemic, NIFA is postponing its 2021 Annual Housing Innovation Marketplace Conference until the 28th, 29th, and 30th of March 2022. Instead, we'll be bringing you weekly webinars in 2021. Our speakers today are Tim Gottgetreau from Western Economic Services, Scott Mertz from Legal Aid of Nebraska, and Kelly Lammers from the Nebraska Department of Banking and Finance. Also with us behind the scenes is Susan Pullis, NIFA's Outreach and Community Development Administrator and the organizer of today's webinar. Susan will be helping to monitor the chat and answer questions. We would like attendees to save all questions until the end of the presentations. You can use the question feature on the right to input your questions, and NIFA staff will hold those until the end of the presentations. If you would prefer to ask your questions out loud, simply raise your hand and we can unmute you, but keep in mind that the webinar is being recorded and will be available online. Thanks again for attending. Our first speaker today is Tim Gottgetreau, Manager of Economic Research at Western Economic Services. Tim performs economic, demographic, and housing analysis, oversees various market research functions, as well as being the lead research and programmer. He has been with West for 9 years, working to improve West products and striving to build excellent relationships with clients around the country. Tim holds a master's degree in economics from the University of Maine. All right, giving you control now, Tim.
Great. All right, well, thank you guys so much for... All right, thank you so much for inviting me. I am sad to hear the conference has been postponed, but I can't wait to get back there. It is a highlight of my year. I have that on the calendar. If you haven't seen me there, you know, we do, like I said, like Joe said, thank you for the introduction. I'm the Director of Research for Western Economic Services. We've been working with NIFA for about 14 years on this project. We produce what is known as the Profile of Nebraska Demographics, Economics, and Housing. It's a massive document containing a whole variety of statistics for every county in the state, statewide, regionals, 31 cities. So it's a huge, huge document. If you haven't checked it out, the next release is actually coming up within the next 2 weeks, I believe. So we'll have some fresh statistics there for you. Part of that large profile and data gathering experience is what is known as the Rental Vacancy Survey, where our firm tries to contact every single rental property throughout the state, apartments, single family homes, mobile homes, or other rental properties. And then we ask a couple of, simple rental questions to figure out what's going on in the rental market. How many units do you have? How many are available? What's the average rent? Can you break that down by single family units, bedroom, number of bedrooms, apartment units, number of bedrooms? So it's a big data set. This year's rental vacancy survey for the upcoming profile just happened to correspond to when the CARES Act, the first round of CARES Act money was going out to help rental assistance. It was also kind of deep in the first kind of wave of the pandemic. So we said, well, let's add some COVID related questions to see if we can track any COVID related statistics based on the rental market. So we did, and I'd like to go over those, the answers to those questions, the statistics that we found, and then also kind of do a quick highlight of the overall rental market throughout the state, and show off, of course, the newest version of the dashboard, which is kind of the digital interactive piece overlying the profile. So, all right. I believe our time limit is 20 minutes, so I will try to stick to that. Joe, please remind me, or just cut off my screen, because I can talk for hours on this subject. So, all right, here we go. COVID-19 impact on the Nebraska rental market. First off, you can play along at home if you want. Like I said before, the newest profile is coming out in the next 2 or 3 weeks. But we have a beta dashboard available with some rental vacancy statistics, some new interactive features. So I asked NIFA if it was okay if we kind of showed it a little early. So we have a little sneak peek here. Y'all are very lucky for logging on. If you want to play at home, we have the beta Nebraska dashboard, westernes.com/Nebraska beta. Like I said, this is still beta. All the data is preliminary, and so is the functionality. We're constantly tweaking it, but it should be made live within the next couple of weeks, finalized and live. But you can see here the COVID impact on the Nebraska rental market. Feel free to click that. It's a special extract that I'm going to start running through, and then I'll kind of dive back into the dashboard. Okay, so like I said, you can play along at home. So we asked, 3 basic questions about to track COVID statistics. It was very new. We could have asked more, but we landed on 3. It's kind of a long survey anyway, so we just wanted folks to answer. We asked, of all of your units, do you have any units that are behind on rent due to COVID? We asked how many units are behind on rent on COVID, and are you anticipating any evictions? We also asked, have you reduced the rental payments based on COVID to any of your tenants? And we did this for all 93 counties throughout the state and 31 cities, but we kind of just, for this piece right here, we're just going to kind of focus on the individual regions. We have several regions: Metropolitan, Lancaster, South Central. You can see the regional map here, just a little bit down, so you can see where the regional boundaries align. When we're looking at the data, we actually found that about 20% of all survey respondents throughout the state of Nebraska said they had 1 or more units behind on rent due to COVID-19. So that's 20%, so that's about 1/5. The variations across the state, there were significant variations, with the metropolitan region having about 29.8% of respondents saying 1 or more units were behind on rent, followed by the panhandle region at 24.6%, and then the south central region. So, that's not necessarily surprising. The metropolitan region is composed of Douglas, Sarpy, and Washington counties. Those are more urban counties. They have a higher rental stock, as we'll see here in a second. So you can understand that that's, you'd see a higher impact on the rental market where there are more rental units. Panhandle is an interesting one, and South Central regions. In these kind of deep dives, in the South Central region, we saw a lot of issues in Buffalo County and Hall County. So Kearney had some high vacancy response rates. I'll just pull up a little spreadsheet here. Buffalo County, about 34.7% said they were behind on rent, had 1 or more units behind on rent due to COVID, with city of Kearney, where are you? With about 35.6. So, kind of much higher than the statewide average. Over here in the Panhandle region, Cheyenne, and the city of Sydney, kind of were highlights or hot spots behind rental payments. And then we have the metropolitan region here as well. So going back up. So this is just, we asked, do you have any units? Yes or no? So the respondents, yes or no. Then we asked, well, if you do, how many units, can you estimate are behind on rent? And that's where the numbers got a little bit different. Statewide, we only saw about 1% of units in our survey sample were behind on rent, but we did see some variation throughout the state. In the Panhandle region, we saw a much higher 2.26% of regions, 2.26% of units are behind on rent. That's not observations, that's actual units, followed by the Northeast region and the South Central region, 1.59. Metropolitan region had, was closer aligned to the statewide average. So, the Panhandle region had both high responses behind and also a larger amount of units. They also had, then we asked the follow-up third question, all right, if they're behind on units, do you anticipate evictions? There's eviction memoriam, so they don't know, but 13.4% of respondents in the Panhandle region anticipated evictions coming over the next year. So that's definitely a standout statistic there. Then we can kind of go down and see here a nice little chart and the map. Okay, the rest of this document is kind of an extract of the survey. You can kind of get a flavor for what we asked about the, in the survey. We have rental vacancy by survey type, total units, and rental units by number of bedrooms. So for the newest version of the profile and the newest version of the dashboard, we're trying to get a lot of this information into our, digital online platform. So as I said before, you can play along at home under the Nebraska beta, upcoming, not yet released, but soon to be Nebraska dashboard. Under this dashboard, we have a brand new tab called the RVS tab, stands for Rental Vacancy Survey. So you can kind of come along and play here. At first glance, it can be a little bit overwhelming, but you can just start clicking buttons. It'll be happy. It's okay. You won't break it. We can see here that under, let's just get off state of Nebraska. This is basically all the unit types, all single family apartment mobile home, and then 1 bedroom, 2 bedroom, 3 bedroom, 4 bedrooms, or total average right there. You can select 2 different areas, Lancaster region or state of Nebraska. I just want to kind of highlight state of Nebraska now, and then we'll kind of dive into some of these areas that I mentioned having a higher than statewide average effect based on COVID. So this is a dual axis chart with vacancy rate and average rent. I did that so, in theory, if your vacancy rates are decreasing, your apartment rent should be increasing. There should be an inverse relationship between the two based on supply and demand. So I just wanted to see if that played out. Most of the time it does. We can see here statewide vacancy rates fell pretty, almost a full point. 4.5% vacancy rate last year to 3.6% this year. So that's a big drop. Then we can look at single family and apartment units. Both statewide are falling for the vacancy rates. So there's there's probably a lot of things happening of why the vacancy rates are falling. We collect, like I mentioned before, a lot of information in the profile, one of which is the Wyoming Department of the Nebraska Department of Transportation. I haven't had enough coffee this morning. Where we, ask about if you move into the state and you get a different driver's license or move out of the state, we can actually track net in or out migration based on where you moved and lived. For the last 2 years, state of Nebraska has been seeing pretty decent increase in net migration. And then 2 years hit 2019, we saw massive net out migration. And the first half of 2020, again, we saw massive net out migration as well. So that could be driving, folks are under that program, folks are leaving the state, which is kind of interesting, kind of opposite of what you'd expect to see in the vacancy rate. However, we do see a lot of folks staying put in their apartments. You're not going to go out in the middle of a pandemic looking for different properties. There are other issues that our survey callers were asking about in the when they followed up of the COVID questions. A lot of rental properties were actually taken off the market. A lot of rental properties were sold in the state of Nebraska. So that could be, decreasing the amount of supply. So that would also, decrease the vacancy rate. If you take supply off the market, it's harder and harder to get more apartment units. And this one is a very interesting thing. Smaller units, so, in the more rural areas of the states, we're afraid to rent out units. If you had a vacant unit, if you were like a 1 or 2, a mom and pop, you had a spare bedroom or a spare kind of rental unit, they were actually afraid to rent out their units because they were worried that they would get stuck with a utility bill. So even if the tenants were not necessarily behind on the rent, they might have been behind on utility payments, and if they moved out or when they moved out, the landlord would then be, accountable for them. So we saw, a number of properties being sold, decreasing the rental stock, and we also saw, people maybe not selling rental properties, but keeping them off the market for fear of, incurring financial loss outside of rental payments. So utilities payments was certainly an issue on a lot of renters' minds, rental properties' minds. Okay, so and then we can also track the average rent throughout the state. We see here average rent in the state of Nebraska for an average apartment rose to about $723. Single family homes, the average rent for a single family home was $872. If you want to see the actual data, you just hit the show tables tab and we're down here in the averages 2020. You can see all the data here. We also broke it down by bedroom. So we can see, if you want to see what's going on in the apartment space, 2 and 3 bedroom apartments, you can see here the average rent for a 3-bedroom apartment has been steadily increasing throughout the state, rising to about $979. And same with 2-bedroom rent rising to about $792. And, vacancy rates as well by bedroom size. So we can see here that, throughout the state, 2 and 3-bedroom apartments are really falling. So folks are staying put, and the supply is shrinking a little bit. If you haven't used the profile or dashboard, it's a great resource to kind of expand the story. Okay, we have all these COVID questions. We know that there's some hot spots in some certain areas. Certainly in the metropolitan area comprised of, Sarpy and Douglas. Lincoln also had some interesting things. So we can go over here and look for city by city analysis, so we can kind of go down and see city of Omaha versus the city of Lincoln. right down here. So we can see Omaha and Lincoln City for all of the apartments. Come on. All right. And we can see here both of the metropolitan, both of the largest cities in the state are decreasing vacancy rates, 2.7, 2.7 in the city of Lincoln, 3.4 in the city of Omaha, and also the average rent as well. This data is available statewide, all the regions, all the counties, and 31 cities throughout the state. So it's a pretty big data set, and it can get pretty wild. If you're interested in downloading and using this data is fully downloadable right here as a CSV or XLS. And if you click all of the buttons, things get very, very crazy on this chart. But you get to extract all of the data as an easily usable piece of data. I do want to kind of zone in the Panhandle, the South Central region had a big go away. It was kind of a hot spot for COVID. Excuse me. So I just kind of want to show how we can sort of expand the story on that as well. In the city, we saw the city of Kearney. Where are you? Okay. Right there. And the county, we'll just go to Buffalo. Like I said, it's all right here, and you can kind of see here that the average rents have kind of mellowed out. They've kind of decreased slightly, stayed constant right there, but you can also see the vacancy rates also very tight. So the vacancy rates are also falling. So although folks are behind on rent, they're not leaving the apartments, they're staying there. Now, why is that? Why wouldn't necessarily Kearney or Buffalo have that issue? You can come over to the economics section and kind of see what's going on in that area, employment by industry. You can kind of really see right here that in the city of Kearney, healthcare, retail, and manufacturing are the largest employers in the city. So retail sectors got hit pretty hard throughout the pandemic, so that would make sense, as well as manufacturing. So these two bubbles right here, the x-axis is the employment, y-axis is median earnings, so you can kind of see here what's going on. And again, you can kind of dial for all of this stuff. Specifically, I had mentioned that Omaha and Lincoln City, Lincoln, had a higher, tenure share. So we'd expect to see, we'd certainly expect to see that, if they have more rental stock throughout a lot of the state, and it actually increased, Omaha City and the city of Lincoln are becoming more renter occupied, rising from 38.2% of owner or households to 41.4%. So you'd expect to see some, COVID related issues where there are just more rental housing stocks. So that's a very quick introduction to that and the COVID related statistics there. Keep an eye out for this to drop. And it's coming up in the next couple of weeks, and I'm excited for it to get out there. And if you have any questions or anything, just please do not hesitate to reach out, or my email is under the help tab. So yep, give us a shout. All right, well, thank you so much for having me, and I will stick around for questions at the end, and I hope I didn't talk too long. So how do I stop this?
Okay, can people hear me okay? Am I coming through? I'm gonna share my screen.
We can see your screen and hear you, Scott. Thank you.
Thank you very much, to make sure I'm not talking to the void here. My name is Scott Mertz, and I am the managing attorney of our Housing Justice Project at Legal Aid of Nebraska. I'm gonna talk today about evictions across the state. Whoops, okay, I lost my, okay. Evictions across the state. Just make this go away. But before I get too far into my information about evictions and what Legal Aid in Nebraska are doing to combat those evictions across the state, I want to start off with just some context about our organization for those on the call who are not familiar about what it is we do here at Legal Aid in Nebraska. Our main purpose, of course, is to provide free legal services for civil matters for those who are not able to afford those. And that includes evictions and foreclosures, certainly, but also for in need of domestic abuse cases, wrongful denial of government assistance, any consumer debt issues. We have 4 priority areas, one of them being housing, and that's addressed by our Housing Justice Project, where we do eviction defense work and otherwise address conditions and utility matters, access to security deposit, various landlord tenant related issues. But also we do provide attorneys for those in need of family law issues, debt and finance, income and benefits. Our organization is, like I said, statewide. And so while I am located here in Omaha, Nebraska, we have offices and attorneys in Lincoln, Grand Island, North Platte, Scottsbluff, satellite offices in Bancroft and Lexington. 91 staff members. That number might be added. It changes pretty commonly, but we are closing in on 100 staff members, and roughly half of our organization are attorneys. And our goal is to promote justice, dignity, hope, and self-sufficiency through quality legal, civil legal aid for those who have nowhere else to turn. And with the focus today being on evictions in particular, looking at the eviction crisis in Nebraska, really during the pandemic. Again, we are trying to provide eviction defense work all across the state, not just in Omaha, Nebraska, or in Lincoln, Nebraska, and we do have attorneys located across the state. So I just want to provide that context when I'm talking about what's happening across the state, that anybody can access our services and apply for an attorney if they are under threat of eviction during the pandemic and after the pandemic, that those services are going to be there and will continue. So one thing I was asked to do here today, I think it provides some useful information and context for the housing crisis and particularly under the lens of evictions in Nebraska is just look at the data and the numbers for evictions during the last calendar year. So zeroing in on just 2020, from January 1 to December 31 of 2020, not surprisingly, evictions were down across the state from where they were the previous year of 2019. We saw the filings of some 5,300 plus cases all across the state in 2020. And that is down from what we saw across the state in 2019 when there were over 9,340 plus cases filed. Again, not surprising in light of the COVID pandemic and the various legal protections that arose over the course of the pandemic, both at the state level, the federal level, and the federal moratorium, changing its nature from earlier in the pandemic under the CARES Act legislation to what we have now with the CDC order. I'm going to get into those, but I want to talk a little bit about what we saw just from looking at the number of evictions and where they're located. This builds upon, I think, a lot of what Tim talked about our rental stock in Nebraska. It is not too surprising that the majority of evictions are, of course, in Douglas and Lancaster County, our most populated counties, but certainly just the scope of how many of the evictions in relation to evictions all across the state are located in just those 2 counties might be a little surprising. Again, looking at 2019, just pre-pandemic numbers, we saw well over 50%, roughly 54% of all evictions across the state were just filed in Douglas County, with 21% in Lancaster County. So for 2019, 3 out of every 4 evictions were in just those 2 counties. Again, certainly we have more people, we have more rental stock in those counties, but as far as just a proportion of the state, this is greatly in excess of where all the people and rental stock is across the state. and that carried through in 2020, notwithstanding the pandemic. But there was a bit of a decrease in Douglas County filings, while Lancaster stayed pretty consistent as it related to a proportion of all evictions filed. Again, reasons for that decrease in Douglas County, while Lancaster stayed pretty consistent with its proportion of eviction filings. In Douglas County and not in Lancaster County, we did have our courthouse shutter for a period of time for in-person hearings and in-person eviction hearings during April and May. So even though individuals could still file the cases during those months, just as they could in Lancaster County, they couldn't necessarily get in front of a judge. So there's a bit of a disincentive for a lot of people to just go forward with filings. And that is borne out in the numbers, where in the months of April, you saw a huge decrease in Douglas County filings of roughly 89% down. And then in May, 70% down in just Douglas County, where again, in Lancaster County and across the state, for other examples, the counties were not as low in filings. So some other takeaways from looking at all of 2020 eviction filings. We saw numbers were down even before the pandemic. In January of 2020, February of 2020, we saw just the number of eviction cases filed down 39% and down 35%. And then as the pandemic really hit us and got serious, we saw huge increases of down 81% in April and down 68% in the month of May. And then as May turned into the summer and to the fall, we saw a gradual increase with some dip and some rise, not a straight line trend, but there was a gradual increase toward the status quo, such that by December 2020, eviction filings were really only down 19% from where they were in 2019. Thus, there was somewhat of a return to normalcy as far as eviction filings all across the state. So that's kind of what we saw. I think of more important is why this is what the numbers showed us. So again, some big takeaways. Evictions were already on track for being down even before the pandemic. So why would that be? Again, there might be reasons related to just the economy, and I think Tim touched upon a lot of the availability of rental stock across the state in 2019. Maybe again, there was just a better access to housing even before the pandemic hit. I would note from what we're looking at in the legal field, there were changes to landlord-tenant laws that did take effect in late 2019. For the first time in really decades, there were changes to landlord-tenant laws that favor tenants and increased tenants' rights. Thus, as the intent behind those changes were to increase the number of evictions and people's at risk for loss of housing. Most importantly, we saw in September 2019 a change in notice requirements for non-payment of rent. Used to be for decades, if someone was behind on their rent, they were entitled to written notice for 3 days, only 3 days to get current with that rent before they could be sued and evicted from their property. That increased to 7 in 2019, and that law took effect in September of 2019. So again, the goal behind that was to put a dent in eviction numbers across the state, and that did seem to be borne out by our limited sample of eviction numbers before the pandemic hit to really color the data, so that we couldn't really track the impact of just that change from the 3-day notice to the 7-day notice. But there was an indication, like I said before, March and April, when the pandemic really took effect, of those numbers already being down. So the greatest impact on the numbers, the greatest decrease on eviction numbers really occurred at the outset of laws that were passed in an effort to combat evictions during the pandemic crisis. This took the form of the governor signing an executive order in late March of 2020, and then followed just a few days later by the passage of the Federal CARES Act, which had a federal moratorium that took effect at the end of March 2020. So that would be the logical explanation for the huge impact that we saw in those numbers of eviction numbers being down in March and April, and then again in, well, so excuse me, April and May really showing the major impact of decreased numbers, not so much in March. As both at the local level, the governor said, you can get a continuance for your eviction hearing past May 31 if you can show that you were impacted by COVID and otherwise lost income or lost childcare, that you had to stay home and couldn't afford to work, then you wouldn't have your eviction hearing until after May. And then with the CARES Act moratorium, the CARES Act impacted the nature of the properties themselves, so that individuals who lived in certain federally subsidized or federally backed properties could not be subject to a non-payment eviction, and that was a moratorium that lasted for 120 days, starting at the end of March. So again, as was the intent behind those laws, there was a significant decrease in the filings of evictions across the state, really in localized in those months of April and May, with some slight increase creeping up over the course of the summer of June, July, and certainly more so in August. So then again, as I said, we saw more of an increase to the status quo numbers in December, and now in early 2021. Here in 2021, we at Legal Aid Nebraska are keeping track of the numbers at a county level, as we are in Douglas County and Lancaster County frequently, and that is where, as I indicated, the majority of evictions occur across the state. So we're trying to do a real-time, week-by-week tracking of those numbers as we try to do outreach as well to individuals who are sued in those counties. And thus we can see in these recent months just an increase getting closer to the status quo in those particular counties of Douglas and Lancaster, where we're just no more than 15% or 10% below where those numbers were in 2020 before the pandemic. So the question is why? Why are there so many evictions still? Again, upwards of over 5,300 for all of 2020, and the numbers are only increasing on a month-by-month level while the pandemic is still going on and while we still have the CDC moratorium in place. So why is that happening? Well, a couple things. One, the CDC moratorium does not apply to all evictions, and I'm going to get to what it does apply to and what it does not apply to, but perhaps more importantly is the number of individuals who do not know about the CDC moratorium, and people have to actually know about the moratorium and actually have to assert their affirmative defense under the moratorium in order to avail themselves of the protections of the moratorium. People are not sued and informed at the time of their lawsuit about this law. They do not go to court and get informed about this law and how it is they may or may not be protected by the CDC moratorium. That is not information that is affirmatively provided by landlords, landlord attorneys, and certainly not the courts. So a major theme of what we deal with here at Legal Aid in Nebraska is information, the lack of, and trying to supply that information. We want people to know about their rights, to know about us, and to have access to an attorney who can find out if they should get the protection of the CDC moratorium and then assert that protection in court or even before court so that a hearing does not take place. So I talked about, again, not applying to everybody. Just a little bit of background here on the CDC moratorium before I get too far ahead of myself. This was enacted in September 4 of 2020. Again, this is after the expiration of an earlier moratorium implemented by the federal government, the CARES Act moratorium. When that ran out and that moratorium covered people who lived on certain properties, there was a serious concern of a backlog, like a tsunami of evictions of people who were protected for all that period of time and yet still not working, not caught up on a rent that they had fallen behind on, and that the country would see all these evictions hit the courts at the start of the fall 2020. So that's when the CDC moratorium kicked in. The Centers for Disease Control and Prevention utilized their powers under the Public Health Services Act and their need to contain the spread of communicable diseases like COVID-19 to say the agency believes residential evictions would cause the spread of the COVID-19. So they want to see a temporary halt in residential evictions. But in order to get the benefit of this moratorium, you had to be a covered person. And in order to be a covered person, an individual would have to sign a document disseminated by the Center for Disease Control and provide that document to their landlord, so that the landlord was on notice that the individual had signed the document and that the document did apply to them before they could get the benefit of the temporary halt on an eviction. And again, that has been extended twice over the course of its lifetime and is currently in place and enforceable, and right now through March 31 of 2021. So what is a covered person under the CDC moratorium? So if you're a covered person, you sign a declaration. The declaration says that you will use best efforts to obtain government assistance for rent or housing, that you are of low income, you expect your income for 2020, which again is now over, was less than $99,000 for the year, and that you're unable to pay your rent due to some manner of loss of household income or some extraordinary out-of-pocket medical expenses. Essentially, you have been hit financially, not necessarily by COVID, mind you, that is not a requirement explicit in the document, but that you've experienced a loss of income or extraordinary out-of-pocket medical expenses that have impacted your ability to get current on your rent. So if that's true to you, then you're going to use best efforts to try to get that assistance and make whatever payments you can. And that if you were to become evicted and homeless, you'd have to take shelter or otherwise go to living quarters shared by other people. Again, thus the risk of spread of the disease. And that you understand that even if you get the protection, you're still responsible for the terms of your lease, and rent is not being forgiven, and nor are late fees being forgiven. A huge distinction between the CDC moratorium and the earlier CARES Act moratorium. Individuals who were covered by the CARES Act moratorium, there couldn't even be late fees that accrued during the time that you were protected by that moratorium. Under both, rent is not being forgiven, mind you, but here even late fees are going to accrue. So you're incentivized to still pay whatever you can pay and when you can pay it, and try to get that assistance. And this is out of date, like I say. It was originally December 31, 2020 in the original document, but now that has been extended through March 31 after 2 separate extensions. So the order says more than that, not just how you are covered, but who is explicitly not covered by this moratorium. That is, individuals who are perhaps guilty of other lease violations not related to non-payment of rent, again, most seriously, criminal activity on the premises, doing things that threaten health and safety of other people on the premises, damaging or being a significant risk of damaging property, or violating various codes, ordinances, regulations, health and safety. And then finally, as a catch-all, really violating any other contractual obligation under your rental agreement not related to the timely paying of rent or other housing related payments. Anything not money related that you're doing wrong or accused of violating the terms of your lease, you can still be evicted for. And that was true under the CARES Act moratorium and true under the governor's executive order as well. For just cause, for things not related to the money, you can still be evicted. And that is, again, why even if individuals know about the CDC and they're using the CDC, they may not be protected by the CDC order, and why it's important to get with an attorney and understand your rights and your particular circumstances. So just some wrap up on the future evictions here in Nebraska, the short-term future. One, is the CDC order going to be extended? The expectation is yes. We, again, saw 2 extensions already. And again, part of the CDC moratorium is to work in conjunction with rental assistance. And right now here in Nebraska, that rental assistance, I'm going to have point 3 here a little bit, but is still forthcoming. For balance of state, people can apply for emergency rental assistance as of last week. That's for everybody but Douglas County and Lancaster County. But we're still waiting on implementation for a lot of the money that was allocated in the previous stimulus bill at the end of 2020. to get to renters. So again, I think there's an expectation it's going to be extended because people still need to access the rental assistance if they're getting the benefit of the CDC order. So hopefully there'll be some extensions so people are afforded that time that they're being protected by the CDC order, but get access to that rental assistance that they still need access to. Litigation around the CDC order, again, there's been cases in the federal courts in Georgia. Back in 2020, it was found to be constitutional, the administrative action by the CDC, but very recently, early last week, a Texas federal court did side with the property owners in finding the CDC moratorium unconstitutional. So the order remains in place. There is no stay or injunction of the order right now. We just expect there to be further litigation at the appellate level. And even just at a local level, there's a lot of litigation pending just about implementation of the CDC order as is. Again, I indicated reasons as to why you would be eligible for the CDC order and reasons why you would not be. There's a lot of gray area as to the in-between. A lot of people are being terminated from their leases, just not getting renewals of leases for no cause at all. As it's perfectly legal prior to the CDC order, the question being litigated is if that non-renewal is for no other reason than but for a person's utilization of the CDC order because of their inability to pay rent, is that not a violation of the CDC order? So we're still seeing some litigation and maybe some more clarity and guidance around that issue. And again, just like we saw in 2019 with changes to landlord-tenant laws in Nebraska in an effort to secure and strengthen tenants' rights, we're hoping to see more of that in 2020 with perhaps some proposed changes to our continuance laws regarding evictions. Again, continuances are really not allowed under current Nebraska law, but for the most extraordinary of circumstances. Thus, it was not considered by members of the judiciary to to continue a lot of these eviction hearings during the height of the pandemic, and again, why so many were still occurring during the pandemic and during locations in the state where the pandemic was even quite serious. So we're hoping to see some changes to the law that they have proposed bills before the legislature right now, impacting just the process by which evictions happen, and unfortunately happen so quickly in Nebraska, and with that, really that opportunity to respond to circumstances and the need for continuances and the need to continue out when there is a public health emergency. Again, another proposed bill would afford local agencies, local municipalities, and local jurisdictions the ability to do moratoriums and continuances as needed based upon the threats to health and safety of individual communities. So more to come from our legislature on landlord-tenant laws in Nebraska, and certainly more to come from our federal government regarding our current eviction moratorium, its implementation, and its length of enforcement. And obviously more is happening with respect to the rental assistance being poured into our communities in greater amounts than happened in 2020. Ideally, these developments will result in fewer, rather a reduction in the eviction numbers for the balance of 2020 as we see the numbers creep up and up here in these last couple of months. Okay, I will turn my screen over or allow NIFA to take the screen away from me. Again, my parting words as far as legal aid in Nebraska has to say is just, again, individuals need to know their rights, and that's why they need an attorney and should come to legal aid in Nebraska whenever they are at risk of loss of housing.
Thanks so much, Scott. Hopefully you all can hear me this time. Our final speaker today is Kelly Lammers. Kelly began as a field examiner with the Nebraska Department of Banking and Finance 37 years ago. He has examined banks, credit unions, trusts, and a few others, holding titles along the way such as senior examiner, review examiner, IT administrator, deputy director, and most recently was appointed director last September by the governor. Kelly holds a bachelor's degree and MBA from UNL and is a Colorado Graduate School of Banking alum. He is chair-elect of the Conference of State Bank Supervisors Education Foundation Board of Trustees. Kelly considers himself a lifelong learner and a student of banking and finance. All right, all yours, Kelly.
Hey, Joe, thank you very much for that intro. Greatly appreciate that. NIFA, thank you for this opportunity. Perfect timing, if you will, relative to following Tim's relative position on what is the economy. Notice how we're looking at current problems at 1% in his early conversation, early slides, and an eviction possibility through the year of 6%. Scott brings to the table the fact that legal aid has a continuing discussion regarding evictions, even though the number of evictions are down. So relative to my topic today on forbearance, forbearance is simply what happens when things do not go as scheduled, as planned. Who would have believed I could go into a bank this way? Who believed my credit union would ask no questions if I showed up at the counter in a mask? The CARES Act, the coronavirus aid, relief, and economic security. What we're going to talk about today is security. Are we labeling the assets appropriately that our retirement funds, that our future relies upon? So with that, my name is Kelly Lammers, as we discussed earlier. These are my comments, not necessarily that of the department. And as typical, let's just start out with what the department does. We charter, license, register, and approve people that touch other people's money. So banks, credit unions, trust companies have a charter. There are a number of different kind of mortgage bankers that have licenses. There are registrations with the department. The department is cash funded. We are not funded through taxes. We're a staff of 67 people, largely running on a break-even operation for our financial institution side. The security side, however, transfers their excess funds into the general fund. So they in fact help with our tax balance, if you will. The department's mission is to maintain public confidence. Do we know what's happening relative to our expectations with financial institutions? And when it comes down to the end of the day, when you want an answer to a question, do you pick up the phone? Do you look on the internet? Do you work with somebody in Nebraska? That's our vision. Today, it's going to be relatively high structured. I, of course, have to do a cross-sell. We've all worked at organizations that cross-sell, and the state of Nebraska is no different than that. We'll look at some mortgage numbers from forbearance, troubled debt restructuring, pointing out that there's many things that have not changed relative to this is a standard conversation relative to working with credit. But what has tremendously changed is CARES. So let's move into that. Department of Labor did an outstanding job this year, moving a number of dollars, if you will, to the people in Nebraska, $2.9 billion. The number I want to point out here, though, is as the people that are listening on a NIFA outreach, and as you consider this topic, are you working with, or are you employed by, or do you own an entity that is having to make a decision today because of lack of incoming orders, because sales are down, that you might have to lay off existing staff because you can't keep them 40 hours? Look at that short time compensation program, if you will. Currently, there's 452 approved employers out there. There's over 6,000 jobs that were saved in the fact that people need not go to full unemployment in order to receive some benefits. Go to Department of Labor, check out that side. HHS, tremendous job relative to what is happening with our vaccinations. The hospitalization, they're keeping a live dashboard on that. Hospitalizations are down in the state of Nebraska. It is absolutely not over. We have much to do relative to addressing forbearance and a number of other topics. With that, have you consider vaccinate.ne.gov, finish strong, if you will, and let's continue to keep that trend moving forward. Today's topic, if you will, Nebraska mortgage loan volume. How big of an activity is this in the state? When I think of Nebraska mortgages, first of all, I consider two different portals, if you will, two different ways of getting your mortgage. Do you work with your bank, your credit union? Do you work with a depository? Or do you work with the mortgage banker, this online solution, working with someone that possibly is a storefront, if you will, relative to finding the right mortgage for you? In the state of Nebraska, using the FDIC as a resource, there's a number of activities that have always taken place. So if you look at our total loans and leases, that top line, if you will, in that top line, it's pointing out that there's been an average of 7% growth from year over year in Nebraska loans and leases. So in other words, the loan volume is increasing. The demand is there. It is not something different this year than it has been before. They're year to year, 7% growth. But now let me move down to this number at the bottom. I'm on line 16, 1 to 4 family residential. Let me point out a couple things relative to the column. First of all, I think of state banks, those that are licensed, chartered, if you will, by the state of Nebraska. 92% of Nebraska banks are Nebraska chartered. The other chartering authority, unique to United States law, is the national charter, the OCC, Office of the Comptroller of the Currency. So what I have is a column on the left, which are all banks in Nebraska, both OCC and state chartered. The column to the right are state chartered, both of these for 12/31 of 20. And then going back to look at a trend, anything in regulatory approach is very much directionally perspective. Are we trending up? Are we trending down? How is the level? So in this case, loans are increasing at 7%. What is our appetite for the mortgage market? Mortgage in 19 scheduled up 9%, and then 20, another uptick of an additional 5%. So in essence, our financial institution, that one side of the pyramid, if you will, still has strong acceptance. How are they doing strength-wise? FDIC indicates that on a standard call report, again, all banks in Nebraska, state chartered banks, and then the history of state chartered banks. Notice that trend is showing that all loans are relatively stable. In terms of 1 to 4 family, again, relatively stable. So we went through a major crisis and we're able to report as of year end 20 that we're stable to improved, if you will. Mortgage bankers. Talk about the other group. This is not the bank, credit union, or trust company. These are the mortgage bankers. How big of an industry is that? Looking at the mortgage banker call report, the 14.4 billion as of year end. That was one quarter previously, up over 15.5 billion. But yet what I want to point out is it started the year very close to where it ended the year. So again, relative to the CARES Act, are we offering stability? There's a number of indicators that are pointing out this works. We add that together in the state of Nebraska. We've got our 16.6 bill from one side, our 14.4 billion from another, and we're working with a $21 billion industry. The industry itself showing, as we looked at banks, not much to say was really different. But as we look at mortgage banker, there is a difference. As we look at, notice the green line, if you will. The green line are those that are more than 90 days past due. In that situation, we have an increase from something in the neighborhood of $200 million to over $500 million, 150% increase this year in that particular range of lending. Notice the others are finishing the year very similar to where they've started out. So we have simply a conversation in a specific market area, if you will. The mortgage call report also points out that if you take all of these numbers and you compare it to the size of the industry, even though that more than 90 is trending up at that $535 million, comparing that to the total billions, we're at 6.68 for a past due. That's a high number in Nebraska. However, the national average is in that neighborhood of 14.65. So we're facing headwinds. We have challenges, but other people, other states have even increased challenges, if you will. Looking at troubled debt restructuring. Troubled debt restructuring isn't new. And that's the conversation that I kind of want to leave everyone with, as well as introduce the topic, and bring out the fact that troubled debt restructuring has always been a component of working in the world of finance. On occasion, things change. CARES was a big change. So what we're saying today, and what CARES brings to the table, is that opportunity to say this type of change is something significantly different, and therefore let's treat it different. Looking at loans and leases from 2017 up through 2020 in Nebraska institutions, you'll see that the loans restructured in troubled debt have actually declined. You'll look at 1 to 4 family residential as well as non 1 to 4 family residential. You'll see those two reflect a general decline. So in other words, there are opportunities to work with entities to get troubled debt restructured identified. We'll get to that shortly. And in doing so, in qualifying appropriately, there are ways of identifying the credit in such a way that it may not actually be troubled debt restructure, even though the institution has identified the need to adjust the original terms. Consumer Financial Protection Bureau, the CFPB, provides a number of interesting graphics. And as they point out, Nebraska historically has performed stronger than the nation. So in other words, Nebraska's unemployment number, Nebraska's availability for jobs, all reflects positively relative to the ability to identify past dues, if you will. However, those that are not in compliance, those that fall out of complying with their terms, even though there has been a restructure, notice those too have been declining. So a decreased interest rate creates the opportunity to refinance. Along with that, unemployment benefits have created opportunities to pay bills, if you will, as well as other stimulus and other programs. So there's a number of things that we have historically tracked. The CARES Act does not change the need to track this, it changes some of the definitions. So what has really changed? Basically, I've given you a history lesson, if you will. The status of the loan is either paying as agreed or it fits some other category. And generally accepted accounting procedures require you to identify those other categories. CARES brings up the ability to modify the rules in specific situations. The one thing I do want to point out is looking at the NMLS, the National Mortgage Licensing System website, they're pointing out that the purpose for home loans, the current renewals, look at refinancing. More than 50% of that current rush, if you will. So the path forward is crooked. The path forward is covered with leaves. It isn't straight and narrow. Nonetheless, it brings out that CARES in defining stability gives us a couple different avenues. One is changes in accounting. The other is direct forbearance. If you've worked with changes in accounting, likely your institution or the entity that you work with, or even your mortgage company, has a traditional stance on forbearance. That goes back to the document that I'm referencing here. Forbearance is changing ownership, changing interest rate, changing maturity, possibly reduction of face value. It could be a number of different things. What CARES really brings out is the ability to potentially skip payments, if you will, or modify payments. Now, when I use the word payments, I want you to think about how a mortgage is structured. Mortgage payment has a principal and an interest and an escrow. Escrow are taxes. Escrow may be insurance. It may include some other types of maintenance if you're in a condo. There's a number of items that in escrow must exist. So relative to forbearance, it may result in a write-down of the loan. Typically, it is not. Typically, it's actually just moving forward a due date, and it's restructuring the amount of debt that's actually owed. If you're following back, you have existing forbearance guidance. That guidance continues to exist. So continue to use that. What really has changed is this exception to GAAP. Generally accepted accounting procedures have been extended. The exception to GAAP has been extended to 1/1 of 2022. So in other words, it's possible to do something that was at one time considered a troubled debt restructure and identify it in such a way that it is appropriate for the customer, it is appropriate for the safety of the investment, and it need not be considered troubled restructured debt provided. So in other words, there's a way to look at this relative to the steps moving forward. OCC has a reference guide. I'd encourage you to Google that, look at the OCC. It indicates that are the modifications due to COVID? Did the modifications occur during the time period specified? And notice this guidance from the OCC is updated to January 1st of 2022. And was the borrower current? If all of this is true, then the modification likely is not a troubled restructured debt. If that isn't all true because they were well past due when they came into it, notice that there's another workaround relative to can the borrower be brought current. And again, if that is true with this modification and it is short term relative to the overall life of the mortgage, then possibly again, it is not troubled debt restructure. Finally, if these do not apply, then you truly have something as you've had in the past, and you notice we've reported in FDIC call reports that there is continuance of troubled restructured debt. So the loan modification and reference guide, again, I encourage you to search for the OCC reference guide. There are many out there. They are all good. This one has pictures. I enjoyed that one. So when you ask for forbearance and you're a consumer and you go to your mortgage provider and say, I'd like a conversation on forbearance, what could that look like? It's important to know who you're working with. If you're working with Fannie Mae or Freddie Mac, there are websites that are available specifically for that. USDA, FHA, and VA, likely there's a call center that you're accustomed to working with. Conventional loans through your bank, your credit union, most certainly go directly with them. The NMLS Consumer Access, they also have a way of looking up those entities relative to a contact name, who is reselling your information. One thing to consider on this, do not give them your credit card. They may ask for the last 4 digits of your social security number, and the slide probably looks something like this. This one is off of Freddie Mac, last 4 digits of a social security number. When going to the forbearance, what can you expect? First of all, it's not forgiveness typically. And COVID forbearance is not forgiveness. So look at this relative to how the payments may be restructured, how that the immediate challenges may be deferred, and look at some of the dates. We are starting to see some advances relative to the program being extended. So CFPB is pointing out that the total requests under Fannie Mae's or Freddie's could be 18 months. Those typically come in 6-month increments. So they must be requested with extensions filed. Finally, what does an institution do with this? Both the OCC, the Federal Reserve, the FDIC, and all of those are all part of the Federal Financial Institution Exam Council, as well as the state of Nebraska through the Conference of State Bank Supervisors. In offering this guidance, there's a number of encouragement, a number of need for the credit to be identified appropriately, for troubled restructured debt to be considered, and at the same time, it may not be troubled in this sign of troubles, if you will. It's an uncommon time. So in summary, there's an accounting way of approaching this. COVID is not typical, so don't expect your typical accounting to occur. CARES allows for an exemption from typical accounting. If you're a consumer and you're having trouble making payments, most certainly reach out and ask about forbearance. No slide is complete relative to the department without pointing out the current PPP program. We're currently at $2.4 billion in the state of Nebraska. That number's trending down. A lot of positive traction there. With that, you know, and it's 60 degrees out here in Lincoln, Nebraska. It's a great day to be kayaking, other than I believe the lakes still have hard water on the tops of the lakes. This was a time when it was at different weather. With that, I'll turn it back to the group and most certainly take any questions. thank you for what you're doing in the state of Nebraska. Appreciate it.
Thank you so much, Kelly. I'll invite Tim and Scott back out so we can take some group questions. Thank you much. All right, our first question we had from the audience: how many rental units are there in Nebraska, and what percentage of them were covered by your survey, Tim? I can't hear you, Tim.
Okay, how about here? Oops.
I hear you. Very good.
You got it?
Yep.
Good. Okay. That's a great question. So we can check that over here. I don't know if you want to share a screen real fast.
Sure.
We can just see here, state of Nebraska. My screen. State of Nebraska, in the most recent 25-year 2019 ACS survey, housing type by tenure. Right down here, we can kind of see here that there were 257,497 rental units. The 5-year ACS survey is a 5-year rolling average. Over that period, we use that because we can get down to very low granular levels. I believe our survey responses covered about, let me see if I can pull it up. Observation units, about 75,000 units in the most recent in the survey response. So, a good chunk of them. I will say that we had some interesting times. It was a harder survey this year because a lot of the front offices for larger apartment complexes were closed due to COVID, or housing finance authorities, they just weren't being staffed. So, our numbers were a little lower than they traditionally have been. We normally hit around 100,000 units per survey, but we came in about 75,000. So it's still a decent sample size statewide. So I can turn off my screen now.
Tim, is that
good.
the same number for the eviction survey as well?
Yes, yeah. So exactly. So in that rental vacancy survey where we contacted 75,000 units, yes, those were included with the 3 COVID related questions.
Very good. Is there a generally accepted ideal ratio of rental properties to homeowner properties?
That's another great question. It depends. Nebraska is an interesting state because it's got 2 urban cores surrounded by a massive rural area. The rural areas just tend to have higher homeownership rates, like up into the 70%. And in those areas, it makes more sense to have a higher homeownership rate because people are living and working there. In those kind of industries, and so I wouldn't say there's necessarily an ideal. You'd let the market take care of that. If the rental prices keep increasing, you want to build rental stock to either mellow out the rental price increase. That'll change your owner tenure share. So it's kind of, as an economist, you just say, well, the market will decide what the optimal owner tenure share is based on your area. But having said that, you want to see a lot of people, homeownership often offers a path to long-term financial stability. So you want to, over time, increase that tenure share to owner-occupied housing. And it is also, often, not often, but it can also lower your monthly payment if you, buy your own house and because you're paying yourself back, and you especially when mortgages are low. So yes and no. Generally speaking, owner occupied housing is better, but in more urban areas where there might be more transplants or people moving in, more fluidity, you'd expect to see more rental housing stock.
Gotcha. Question for Scott: with the eviction moratorium eventually ending, whether it be allowed to expire or when the program ends, is there an expectation that evictions are going to skyrocket?
Yeah, certainly on a national level, yes, that's an expectation, because on top of the CDC moratorium, and there's been a lot of local moratoriums that have done a lot more to just fully put a halt to evictions. And then when those were loosened up, that's when the CDC kicked in to help take over and prevent that tsunami from evictions hitting. Here in Nebraska, there's going to be an increase, because that's something we can say pretty confidently, because we do see the lower numbers right now due to the CDC moratorium. So there's an expectation when that's loosened up, the numbers are going to go up. Just as when the CARES Act moratorium came to an end back in the summer of 2020, we saw, just in that small sample size of about 30-day window, a big increase in the eviction filings before the CDC order took effect in September of 2020. So maybe not as big as other parts of the country, just because at a local level, Nebraska has not done as much as many other states have done to just fully shutter evictions from happening during the pandemic.
Okay, and just to follow up on that then, is there concern over legal aid about capacity to handle any incoming surge, or braced and ready?
Well, yeah, we're staffed. We're trying to increase our staff, and in order to, meet the needs, pandemic or no pandemic, really just to ensure that anybody who's under threat for loss of housing has access to an attorney, just to understand, should this be happening, what options they have, trying to negotiate any favorable results, things like that. The best thing we can do to combat an increased number of filings is just make sure people get to us and know about us to get to us ahead of time, as problems are easier to address and deal with, and maybe resolve prior to hearings than having a lot of people come to us right at the day of their eviction hearing, and too often after that point.
Okay. For people just in general who are living under the umbrella of the eviction moratorium, this is probably just a general question for anybody. How can people best position themselves to come out of this, not probably unscathed, but at least as well as they can?
My immediate answer is do what you can in order to apply for rental assistance that's going to be made available, just to make sure that whatever you're eligible for, if you're covered by the CDC moratorium, it means that you're behind on rent and for cause, for some reason, and that should be met with the that need should be met with the rental assistance. The idea behind both the rental assistance and the moratoriums that they're going to work together to try to get people back to a point pre-pandemic, both the tenants and the landlords, to just ensure people are secure in housing, but also secure in their debt or their mortgage payments if they're a property owner.
And Joe, I might jump on the top of that and simply encourage people to work with their bank, work with their credit union, consolidate their funds so that they know where their money is, get an account open so that if there are future opportunities for relief, so that can be directly deposited into an account that they control. Work with those institutions to let them know what the challenges are, and possibly those institutions can provide a platform, if you will, relative to where to go to get more assistance. But by no means does that offset that individual having to make their own calls as well. But it gives them one more resource, if you will.
Wonderful. I'll just add on to that if you think you may be eligible for support there, please visit at coronavirus.nebraska.gov. That'll be for residents of broader Nebraska, so not Lincoln, Lancaster, or Omaha, Douglas. Any final thoughts from you gentlemen? We are out of questions.
Well, just thank you so much for having us. It's always a treat seeing you.
Yes,
well, thank you very much.
And Joe, I'll throw in, I would never pass up the opportunity to close, heaven forbid. Simply, and Scott, I see you may have it queued up for another comment. I just want to say thanks to everyone for continuing to work through unprecedented challenges. I mean, this would have been a very easy time to simply say it's too hard to move forward. And what everyone on this call is experiencing is the fact that they see a path forward. it might not be a smooth path, but it's one that we've proven that we can make a difference in. So I appreciate everyone's work. Continue to work with those resources that you've got. And if those are short, call others. That website that you've listed has a number of opportunities. So appreciate the opportunity to talk today. Thank you, NIFA, for sharing your network of contacts with us.
Well, our pleasure. Thank you so much. Any last plugs before I do the plugging of my own?
I'll take an opportunity to plug anystats.org is where you can view the upcoming profile and dashboard. It will be released, the newest one with all the updated data for all 93 counties, 31 cities, statewide. Will be released hopefully in the next couple of weeks. We're still putting the final touches on it, but it corresponds normally to the Nebraska Housing Conference. So keep an eye out for that, and keep an eye out for the new version of the dashboard. We're excited to get that out. And I'm excited to see you in 2022. Thank you.
Just website, for your websites, legalaidofnebraska.org. That's where all our information is. If anyone you know is in need of legal assistance, they can apply online, or we have the phone number or hotlines and hours of operations there. Again, anyone under threat of loss of housing, there's a legal component and a financial component. Do not just go with one over the other. We're trying to address both and plug people in where they need financial assistance if they come to us first.
All right, well, thanks again, gentlemen. I'd like to thank everybody for attending. A special thank you again to our presenters today. I'd also like to thank our sponsor, First National Bank of Omaha. This webinar has been approved for 1.5 hours of continuing legal education. If you'd like credit for attending but have not yet entered your license number, please contact us at outreach@nifa.org. Registration is open for our 2021 annual LIHTC compliance training to be held March 15th through 17th, 2021. There is also still time to register for lender training until tomorrow, March 4th. You can register by going to our website, nifa.org. Remember, this webinar, along with all previous webinars, are recorded and available at nifa.org under Community Development Training and Webinars, or on our YouTube channel at NIFA Housing. Final plug as well for housing.ne.gov, a free website for listing and finding rental properties. Next week's webinar will be on long-term emergency management, so we will see you then. Thank you all.
Thank you.